Hello, I'm Dick.
And I'm Eric, and we're the Annuity guys.
Eric, everybody's interested in beating a tax man.
And nobody likes to give up
one way or another. How can we do it with annuities?
Well, there's a lot of different ways that our annuities are tax advantaged, and I think getting into the different kind of components will help people kind of understand how they can utilize at least annuities, at least to avoid the tax man, if not, I won't say outright beat him necessarily.
Well, they say the difference between tax avoidance and tax evasion is about 10 years. We don't want any tax evasion.
I was going to say we don't want any tax.
Everything's above board.
That's exactly right.
But it's really in many ways our civic duty to pay as little tax as possible, because we know that that's just going to inspire the government to waste all of our money. The more you give them, the more they spend.
Well, I was going to say, we probably should avoid the political conversation.
Yeah, exactly. We'll stay politically correct here.
But I guess the one thing, and just to kind of start the conversation, we've kind of, there's a little known thing about kind of non-qualified annuities.
Yeah, right.
That stretching them.
Yeah, stretching.
And people are probably aware of stretching IRAs and such, but we definitely want to make sure at some point in time we cover how to stretch because a non-qualified annuity.
Exactly, and I think let's hit some of the key points about annuities, and if it's okay with you, we'll just kind of save that one till last.
Okay.
And then we'll go into a little more detail on it, because and folks, just so you know, these different aspects of annuities and taxation and that. We could spend multiple videos even on any one of these points, and maybe just as a disclaimer, we're not CPAs.
No, I'm not an accountant, nor do I play one on YouTube.
and we're not really giving tax advice here, but we are giving you concepts, general concepts, and as you get deeper into planning with annuities, you need to understand these concepts so that you can work with your accountant and your CPA and have a very frank discussion about these things, and also a planner that that you're going to work with in financial planning has to know these concepts very well, even if they're not an actual CPA or whatever, so they can get you going in the right direction and then just kind of fine tune it a little bit with the tax guy. So okay, let's get rolling on some of these. Income tax deferral. That's a big part of annuities.
Well, it's a big part of every annuity, yes.
Yes, and one thing that I think folks don't really always understand is that you get to defer all of the tax on a deferred annuity, but there's no reporting. You don't have to report it to the IRS. You don't have to give them a running total of your growth of the annuity or the amount of money you've made with the annuity. So it's kind of an off-the-radar item, and people like it for that reason. That it's it's not like getting that 1099 every year on your savings account or your CD. Exactly. And with the newer annuities, I mean, they can rack up some pretty good interest gains. So you're making 5% a year or 6% a year, and I'm not saying that you're always going to do that, but you might average 4, 5, 6% even.
So you're deferring it down until you start taking withdrawals. So
exactly.
Now, and we'll start talking about withdrawals. Wouldn't it be nice as a retiree if your tax distributions
weren't taxed?
And so there are some states out there that actually do not tax retirees' annuity distributions.
Like Illinois.
Illinois is one of them.
And we have to make that clear.
Right.
The federal taxes still do.
Uncle Sam's taking his cut. Sorry, but
it's really nice in some states where they just don't tax annuity distributions, withdrawals, income once you're retired, and there's some trigger point there in age or a consideration for what's the difference between a retiree and a young guy avoiding tax.
But if you're relocating, you're retiring, you're trying to decide where to go live, that may be one of the little things. Some states have no tax at all, but that is another thing. So now, one of the things we always get questioned about is when somebody has a 401k and they're getting ready to move it, and they think an annuity would work, and they're like, but I don't want to pay all the tax.
Won't I pay a lot of tax when I do this?
And the answer is no, not if it's done properly.
Exactly, because when you move your money from a 401k or another IRA, you move it into an annuity, it just becomes an IRA. It's just like another investment. The IRA is kind of like a house that holds the investment, And so you just move it over to so it remains an IRA. You just put something else in it.
So yes, you are not taxed on the distribution pay. What you're moving into the annuity is not taxable at that point in time.
Well, there's so many benefits that people see in annuities when they start looking into them, and they're kind of like, wow, I would love that safety, and I would love that guaranteed income. I just don't want to pay all this tax up front, so don't worry about it.
That should be a deal. It should not be a deal breaker. So, what about Roths? Can we utilize a Roth strategy with annuities?
I've done a lot personally with clients in the past with Roths, and it's just amazing what that Roth strategy and that can do if it's done under the right planning circumstances, where you can actually get someone's future income set up to be completely tax-free. It also works, and that's for an annuity. And there's all kinds of beware of annuities which they're overtaxed, this type of thing. So that you're going to pay too much tax with an annuity. But really, again, it's all about planning and knowing what your needs are. And if you do it right, a Roth can actually give you complete tax-free income for your entire period of retirement.
Your entire lifetime, because the distributions can be entirely tax-free.
Exactly.
Now, you're going to pay the tax up front.
Right, exactly.
But we're tax avoidance, but we're tax-free for down the road, and there are strategies on how to do that.
And then on the Roth, there's one other aspect that's so important, and that's wealth transfer. I mean, how about getting the money to grow at a good, safe, reasonable rate of return, reasonable interest rate, and then pass it all on tax-free to the heirs. That's what a Roth can do.
Wow. And so, the heirs then get to take the distributions tax-free.
Exactly.
So what about annuitization here? When we're talking about what happens with the exclusion ratio?
Well, the first thing to be aware of on the exclusion ratio, it's really a great thing, but that's really more for the non-qualified type annuities, because when you have an IRA type annuity,
everything's taxed.
Everything's taxed in it because it was never taxed in the first place. And another thing, Eric, they have to be aware of, we've covered this on other videos, is that excise tax for some states charge.
Right. When you do an immediate annuity, they want to get their money up front, and so they charge you. Think of it as it's basically a premium tax on buying an immediate annuity. There are 6 states that.
So some states charge nothing on any earnings, and other states tack a little more on.
That's right. But the exclusion ratio is basically each payment of an immediate annuity is part per return of principal and part interest. So you're only paying taxes on the interest portion. So it's a much smaller tax hit at that point in time.
Well, hence, we're now down to talking about the stretching. And let's first of all just talk about the concept of stretching and how it comes about with an IRA.
Sure.
And the idea, folks, of the stretching is that an IRA is typically all taxable money. So if your beneficiaries, your children, get that money, typically they're held to a 5-year rule where they only have some choices of taking a little bit out, a lot out, or whatever, waiting up to 5 years. But whenever they take that money out in those larger amounts, there's a lot of tax due.
And that's exactly it. So, and that's what you've talked about for most people that have an IRA, your required minimum distributions. That's what you have to pull out of that IRA every year.
Yes.
So when somebody passes that owns an IRA, that's what the beneficiaries are left with the choices of. Or do I take it all now, pay the tax on that big amount, and it's an ordinary income tax.
Right.
So if it kicks you into a higher tax bracket,
it's exponentially higher taxes.
So, but if I'm a 30-something, a 20-something, I can take that IRA and then just pay take distributions over what would be considered my life expectancy.
Right, based on your life expectancy, and not an older person's. Very small RMDs.
Smaller distributions.
And so that's the only portion that's going to be taxed, is just that portion of the distribution. And so it's really a great thing. A lot of folks that I've talked to and clients that have said, look, I've got this money, I want it to go on to my children, but I want it set up for their retirement. And that's where a stretch can really help with that. Now the next thing that we really want to talk about, which isn't that well known, because not all companies do it.
And that's the other caveat here. We should make that clear. Not every insurance carrier does this.
Right.
So, but it's when you have a non-qualified, non-IRA dollars, you can actually stretch the annuity with them as well. So we're talking about the tax deferral benefit here of taking it not just from you and then now passing it to the next generation. Much smaller, again, packets of withdrawals that they can take out, and actually they can take the whole amount at some point in time in the future.
Yes.
They're not required to just take that. Well,
to only stretch it.
They do have to take at least the minimum distribution amount based off their life expectancy, similar to the IRA, but they have the flexibility then of having a much smaller taxable consequence. And think about the number of years and number of, from a tax standpoint, the amount of savings you can have because of the amount of time.
Well, and as we discussed a little bit earlier, the annuities nowadays, some of the non-cap strategies and that have the ability to average a higher rate of interest. If you're in retirement and you have your annuities and that type of thing laddered, so that that goes for 20, 30 years, you could have sizable gains in an annuity. And rather than having that all come out at once and be taxed, it can be stretched out over a long period of time.
Over your lifetime.
Yes.
So there's definitely some ways to beat the tax man.
That's right.